All right, so now that we finished our first exam, we finished the first section, which is going to be chapters 1 through 6. So now we're going to be diving into new material for chapters 7 and 8. Now, this isn't technically new material just because, again, everything that you learned in chapter 5 and 6 is the same exact idea because we're still doing inventory. This time, we're looking at the other tracking method, right? So we learned periodic for chapter 5 and 6. Now we're learning perpetual as of chapter 7 and 8. So in this case, all this stuff is going to be a little bit review, but I'll tell you what the differences are, especially when you record purchases and especially when you do sales. Because remember, we'll talk about the definition of periodic versus perpetual again. So in this case, everything that you learned from chapter 5 and 6, I don't want you to forget it, but I do want you to take it out of your head, put it aside, because now we're going to be learning perpetual inventory, okay? So again, merchandising inventory, we talked about this. So everything's the same, where when we are looking at doing business as a retail store, right? We're usually buying merchandise that's already made for us and we're just buying it and we're just reselling it, right? So in this case, what we're doing here is we're essentially buying goods with cash and we're going to convert that goods into sales and that sales back into cash. Okay, essentially that's the main goal here, right? Now, what is included in the price of merchandising inventory? Well, we've already talked about this, right? We talked about that it's going to be every single cost it takes to get the asset to your store. So therefore, if I were to buy it out from like an outlet mall, right, I'm subject to have to pay for the sales price and sales tax because I'm buying it from the actual store. Okay, you are absolutely 100% charged tax if you actually go to an actual store. Now, if you buy it online and you tell them that you are a business, they may or may not be able to tax exempt you. Okay, but it's still going to be one of those options that are available, right? Again, freight expenses, expedited fees. So again, if you have to pay for a higher price to get the items to your store as soon as possible, again, that's going to be considered an extra cost to the actual inventory asset itself. So again, it's going to be totaling the total cost of goods sold is going to be every single cost it takes you to get the asset to the store. So including all of those extra costs. Right? So let's go ahead and talk about inventory and tracking methods. So again, we talked about periodic already, right? So what's the difference between periodic and perpetual? Well, we already defined what periodic and perpetual means, right? Periodic means every once in a while, and then perpetual means that we're constantly in terms of constantly updating our inventory. So that means every single time we purchase our inventory, we update it. Every time we sell our inventory, we update it. So in this case, doesn't matter whether we do a physical count, whether it's daily, weekly, or bi-weekly or monthly, right? You should have a rough estimate of actually knowing how much inventory you have on hand at all times. Of course, that also excludes, in case people like steal merchandise or people sell it but don't record it. That's what that is going to be. It's going to have that assumption where it won't record that. But in this case, yes, usually a physical count, when you actually do take a physical count, it should be more accurate because you're constantly updating the inventory based on a purchase and a sales basis. Okay, so again, now here's the huge difference between periodic versus perpetual. All purchases are going to be made directly as an inventory asset. Okay, meaning every time you purchase something, it goes straight into inventory. So that means you're going to recognize it as an asset account every single time, where opposed to periodic, we recognize them as expenses. So that's the huge difference there. One, we're recognizing that we bought inventory And we're going to put every single cost that is included to the price of the inventory in inventory. Okay? So that's the huge difference, where periodic, we record them as expenses, and then at the end of the accounting period, that's when we recognize them as inventory. In this case, when for perpetual, we immediately recognize them as inventory. That means it's going to be inventory regardless of wherever point in time you are in your inventory worksheet. Okay. So let's talk about perpetual inventory again and how we make purchases of inventory, okay? So here's the first example here, where on July 1st, right, XYZ company purchases 100 toys, okay, costing $5.65 each from Toys U, okay? And a freight cost, of course, $100, okay, record this transaction. Now, periodic inventory, we remember that we had to separate our costs, right? In this case, what we have to know is every cost is going to go straight into inventory. So therefore, I'm going to recognize my inventory item, which in this case, I purchased toys, right? So that's one thing that you need to know too, is that when you're buying a specific item, recognize what that item is, okay? Again, you wouldn't be wrong if you put inventory, right? That's just the generic account. But in this case, yes, it's inventory / whatever the item is. So in this case, I bought inventory toys. Now in this case, what you notice is because all the cost of the inventory item, so the freight costs, the taxes, the shipping and handling, they're all going to go straight into inventory. So therefore, you're only going to be recognizing one account, inventory toys, and you're going to include both the purchase price and the freight together. Okay? So therefore, you'd be looking at $665 instead of earlier when we did a purchase expense and a freight expense, you had to separate them, right? In this case, it's combined into one, and it all goes straight into inventory. Okay? So again, much easier, right? That way you don't have to identify all the different expense accounts. All you have to identify is just one account, because everything's going to go directly into that inventory account. Okay? Any questions?
No.
All right, next section. All right, so now we're looking at perpetual inventory, purchase returns, and allowances. Well, of course, like we mentioned, right, if you have the capabilities to purchase your items from your vendors, you also going to have many reasons that you will have to return the product. So again, many oftentimes, right, when they are being shipped over, whether it's overseas or whether it's being shipped from one state to another, oftentimes you will get broken items due from shipping. You might even have defective items. You might even they might even send you the wrong item, because again, you're buying thousands and thousands and thousands of them, and the person who's transferring all these boxes out of their truck, they might grab the wrong box. So again, there are many reasons that you can be having a reason why you want to return those items, okay? Because in this case, right, this is their name that they're trying to market to you, right? And if they're trying to sell you a product and they send you the wrong item, they're not going to make you pay for it in this case, right? Because that's their name on there, right? So in this case, they would most likely to do a lot of things for you. So again, we talked about a vendor relationship, right? If you have a relationship with a vendor, because they know that you are selling their product, they are going to be giving you unlimited special offers because they're trying to sell you their product so you can help them sell as well. So in this case, they know that you are buying in large quantities in bulk, right? So they're going to be giving you as many special offers as possible to try to retain your relationship, right? So those can include extra discounts, special offers, unlimited returns, and of course, money back guaranteed. Okay. So now let's talk about actually doing the return portion. So let's first record that we purchased some coffee mugs, right? On January 1st, you purchased 100 coffee mugs on an account from Cuppy's Co. And they cost you $1.25 each, with the freight costing you $100. So record this transaction. So again, everything's going to go straight into inventory. So we're going to recognize that we purchased coffee mugs on an account. So in this case, because we have to combine everything together, my coffee mugs are going to cost $125 plus the additional of freight, and that's all going to go into my coffee mugs account, which is going to cost me $225. Okay? And of course, I place it on an account. So then let's go ahead and take a scenario number 1, where in this case on January 5th, you received your items and found that 10 of those coffee mugs were actually broken. Okay, so again, you requested for a full refund, all right, and for the broken items, and of course the vendor grants you the full refund, so record this transaction. Okay, so in this case, right, we're going to return the items, right? Because in this case, we're going to get a full refund. Now, how is this going to be journalized? Well, in this case, where did we originally place my coffee mugs?
In your inventory.
In your inventory. So if everything goes into inventory, guess what? Everything is going to come out from inventory. So that's why this was going to be the most easiest one, because instead of having to memorize, oh, I have to make a contra account, I have to make a contra account, you only are dealing with one account and one account only, that inventory account. Okay? Now again, if you are a company that sells multiple items, you want to address what kind of items that you're actually buying, right? So you don't get confused which inventory items that you are actually returning and purchasing. So in this case, because I only have coffee mugs and that's where I place my inventory, then that's going to be where I'm going to be refunding my inventory from. So in this case, because I put it on an account, I didn't pay for it yet, so they're going to reduce my liability. However, they're going to be taking it out directly from my inventory. Now, in this case, right, what can and what can I not take out? In this case, if I'm going to be returning 10 coffee mugs, I can only return the original selling price. Freight cannot be returned. Sales tax is going to be obvious. You're going to get your sales tax money back if you did get charged. But shipping and handling are separate costs that you had to encounter for getting those items to your store, right? You could have gone up to the store and bought it from yourself, but no, you required some shipping cost. So in this case, you can only return the original purchase price, which in this case, I originally purchased each coffee mug at $1.25. So in this case, 10 times $1.25 gives me $12.50. So that's the only thing that I can actually refund. Okay. So again, because we are a small business, we do have the ability to also get an allowance from our vendors, because again, if they decide to send us the wrong item, they can renegotiate with us saying, well, there's nothing wrong with selling these items, right? You can make it a limited edition item, but at the end of the day, they're also going to send you some kind of discounted amount, because they need to also reprimand for their mistake. They sent you the wrong items, or in this case, maybe the truck driver picked up the wrong box. It's their mistake, so they're going to be trying to discount you at the same time. Okay, they're not going to make you pay for inventory that you didn't purposely buy. Now, in this case, so again, for an example, on January 5th, you received your items and found that 25 of those coffee mugs were the wrong size. Okay, and of course, you requested for a full refund on the extra large coffee mugs, but the vendor somehow convinced you to keep those coffee mugs because they're in good condition. Once again, maybe it's a special edition, a limited time offer only. These extra large coffee mugs. Okay, and the vendor also gives you a generous 20% discount to reprimand for their mistake. So let's go ahead and record this transaction. So again, we're going to reduce the accounts payable. And once again, where did we place our coffee mugs? We placed into inventory. So therefore, we're going to take this amount out from my inventory. Why? Because now 25 of those coffee mugs are at a discounted price. Where when we originally journalized it, we journalized it at a at full price, right? So in this case, now that I'm discounting, right, that means everything's going to be taken. If everything's being put into inventory, everything's going to come out from inventory. So in this case, we're going to take this allowance out. We're going to figure out what this discounted amount is. So again, 25 cups. So again, you can only get discounted off of the items that are wrong. So in this case, you get 25 times that $1.25. So you get $31.25. And a 20% discount off of that is going to give you $6.25. So, therefore, you're going to reduce your inventory by $6.25. Now, remember, this doesn't affect your quantity, right? It only affects your total cost because you paid 25 of those coffee mugs at a discounted price. Okay. Any questions?
I'm good.
All right. So last section for today is going to be section 7.3. Well, of course, if you are able to return your products, you are also very eligible for getting some discounts. So we talked about discounts, right? We talked about terms. Terms is when a vendor gives you an incentive to pay for the inventory items, right? Or anything. It could be supplies as well. So in this case, right, this is a 2%, 15, net 30. Now again, this is a condition that must be met. Okay? And what this condition means is that you have to pay within those 15 days in order to receive a 2% discount. If not, the original total of the bill is due entirely in 30 days. Okay? So in full by 30 days. Okay? So again, this is a incentive for vendors, right? For us, right? So they can receive the money a lot quicker. So especially when you're buying in bulk, that's the thing. When you're buying in bulk, a 2% discount is actually a lot of money. Okay? Then, of course, us as a person who's purchasing these items, right, taking a discount at any given opportunity will lessen the cost of the inventory items that you purchase, right? So in this case, taking advantage of that 2% discount is something that you want to look forward to. So again, terms is an incentive. It's a way for vendors to receive their money as soon as possible. And by doing so, they grant you a discount. Now, that's a condition because you have to pay in order to receive the discount. So again, we talked about two different methods that you can record. So net method versus gross method. So again, net method we talked about before, right? Is where as if you're really good at paying your bills on time. Let's say you pay all your bills on the first of every single month. Then therefore, you can go ahead and record this purchase, right? Because as soon as you receive the items, you're going to pay them as soon as possible. So therefore, net method allows you to take the discount immediately. So then you don't have to adjust your inventory accordingly. Where gross method is more for more smaller businesses who are not quite sure if their money is enough to pay for things right away because they might have other expenses that are definitely much more priority, such as rent and paying your employees, are way more priority than it is to pay off somebody. Okay, so in this case, gross method might be an option if you're not very good at keeping track of your, um, payments and things like that, and you don't want to overspend. Then wait until the day comes and then you pay, and then you record the discount afterwards. So again, net means you take the discount immediately. Gross, you take the discount later. Okay, so again, let's talk about net method. So in this case, right, if we decided to purchase on February 1st, you purchase 100 coffee mugs on an account from Cuppies Co. And again, each cup is $1.25. Freight was 100. And of course, you were given a 5% 10 net 30. So record this transaction. Since we're using the net method and we're saying that we're really good at paying our bills, we're going to go ahead and recognize it at the discounted price. So you're still going to have your inventory coffee mugs and you're going to have your accounts payable. But this time you're going to be recording the number at the discounted price versus the original price, right? So in this case, you can do 100 times $1.25, which is 125, and you take that 125 and you're going to multiply it by that 5% discount to get you $6.25 off. And you don't record that there is a discount. So in this case, you're going to record it as is at $118.75 plus $100 shipping at $218.75. Okay? And of course, scenario 1, if you decide to pay, then you just pay for what you owe, which is that $218. But again, if you end up missing that discount period, then you're going to have to re-recognize it and put that discount back into the mugs. Okay? And of course, gross method, right? We're going to do this where we're recording it at original cost. So in this case, we already know 125 plus 100 is 225. And then it's only till the day when we wait till February 9, we make a payment, right? Then we can go ahead and discount our coffee mugs. And again, everything's going to come directly out from my inventory items. Okay, so which we already know was that $6.25. Therefore, you pay significantly less. Okay, and of course, if you miss the discount, then you're just going to pay in full for the $2.25. Okay, so straightforward. We learned about this in the previous chapter, but this time, instead of using purchases, purchase expense, purchase discounts, purchase yada yada, all you need to know is everything goes into inventory, everything gets taken out from inventory. Okay, so right here, this example here. Okay, that's all you need to know. Okay. So chapter review, we talked about the perpetual inventory, right? That when we make our purchases of perpetual inventory, we immediately recognize the inventory item for what it is. And it's going to include all the costs that are associated with that inventory. So again, cost of goods sold is going to be every single cost it takes to get the inventory asset to your store. Okay? And again, we said everything's going to go into inventory. Okay? So then when we actually return the items, right, this is what happens. Okay? And this is where we talked about discounts, the net method versus the gross method. Okay? Okay, any questions in regards to 7.1, 2, and 3? Okay, no? So let's go ahead and practice journalizing our transactions here. Okay? Starting here, right? It just says journalize. On April 5th, you purchase 1,000 units at $5 each, with the freight costing you $100 on an account. And terms were given 5%, 10, net 30. So there's the first one. Okay. It is April 5th. In this case, I am purchasing 1,000 units at $5 each, with a freight of $100 on an account. So how would I journalize this transaction? So in this case, can you identify me what I purchased?
Okay, you purchased 1,000 units at $5.
Okay.
So that'd be 5,000 units.
Okay. Five.
And okay, go ahead.
Not 5,000 units. So you identify units. So in this case, what would I use instead? In this case, you can use units, but mostly since I don't know what the item is, what account would I be referring this to as?
Inventory.
You would refer it as inventory. So good. So I made a purchase of inventory. Okay. How did I pay for it?
On account.
On an account. So accounts payable. Okay. Now in this case, right, so what's my grand total that I'm going to be putting into my inventory?
It would be 5,100.
It'd be 5,100 because in this case, we put the $5,000 into inventory. What do we do with the freight cost? We also shove that into inventory, right?
Right.
So in this case, that's correct. It's going to be $5,100. Okay. And I'm going to go ahead and I put a little description here so I know what I did here. Okay. We purchased 1,000 units at $5 each. Okay. And then you can also include the freight. But what I want to really include is the terms that they gave us. They gave me a 5% discount if I paid within 10 days. If not, it's due in 30 days. So 5% if I paid in 10 days. If not, it's due in 30 days. Okay. So then on April 7, I end up returning 200 defective units for a full refund. April 7, I end up returning 200 damaged units for a full refund. So how would I journalize that?
Will it be accounts payable?
Yes, because in this case, there's nowhere where I said that I made a payment to this. So in this case, it's going to reduce the accounts payable. Okay? And where am I taking this refund out from?
Inventory?
You're taking it out directly from inventory. Excellent. So in this case, how much? Well, I only bought one batch of inventory, right? So how much did
Right.
it cost me per item?
$5?
It cost me $5, right? So in this case, if I'm returning 200 of them, how much am I going to get a refund for?
It'll be $100?
One more zero.
$1,000?
Be $1,000, right? Because we're returning 200 of them, right? Not 5 of them or 20 of them. Okay, so in this case, I'd be refunding a total of $1,000. Okay. So again, I'm going to make a note here. That we returned 200 units at $5 each for full refund. Okay. Then April 10, I end up purchasing 750 units at $5.75 each with a freight of 75 on an account. Terms are 5% 10 net 30. So I made another purchase on April 10.
So it'd be inventory
Mm-hmm. And what else?
and accounts payable.
Excellent. So that's going to be, just going to copy and paste this one here. Okay, because we got inventory and accounts payable. Now, how much if I purchased 750 units at $5.75 each with the freight of 75?
$4,387.50.
Good. Okay. So then, right, April 15 rolls around and you end up returning 50 of those broken units due to shipment for a full refund. So in this case, we're going to get another full refund on the 15th of April for 50 broken units.
So we're going to do accounts payable
Mm-hmm.
and inventory. We're going to credit.
Mm-hmm. I'm just going to go ahead and put it on the second page over here. Okay. April 15. And what are we going to do? We're going to return 50
Right.
broken units, right? And they cost me $5.75 each, right? Because in this case, it's a few days later. You purchase new inventory, so you open it up, and it's going to be that last batch of inventory that you just purchased. So in this case, it's going to cost me $5.75 each. So how much is it going to? How much is the refund going to be for?
$287.50.
Good. Okay. So then let's see here. April 20th, we end up purchasing 200 units at $6 each with a freight of 20, right? On an account, terms again were 5%, 10, net 30. Okay, so this time we purchased 200 units at $6 each. Okay. So if I purchased 200 units at $6 each with a freight of 20, what is my grand total amount here?
$1,220.
Good. So then April 22nd, 25 of the units were the wrong color, and we were willing to accept a 20% discount. Okay. So in this case, 25 of those units were the wrong color, but we were willing to accept the inventory items, but also at the same time receive a 20% discount from the vendor. Okay. So how would I journalize this transaction?
So would it be accounts payable?
It would be accounts payable. What else?
And inventory?
Mm-hmm. Right? Because if everything goes into inventory, everything's going to come out of inventory. So that is correct. Okay. But in this case, right, we're not returning, right? We're getting an allowance, okay, for 25 units, okay?
What was the discount? Oh, okay.
I believe it's 20%. Okay, let's double confirm that. So on April 22nd, 25 of these mugs were the wrong color, willing to accept a 20% discount. Okay. So in this case,
So accounts payable is going to be $30 and inventory is going to be $30.
good, right? Because 6 times, or sorry, 25 times $6 is going to give you $150, and we're only going to get 20% back, which is $30. So good. Yes, good. Okay. And then here on the April 25th, you end up purchasing 500 units at $6.25 each, with a freight costing you $50 on an account. Terms are 5%, 10, net 30. Okay, so once again, another purchase. Okay, so this time we purchased 500 units at $6.25 each, with a freight costing you $50. So in this case, what's my grand total amount for my purchase here?
$31.75.
Good. $31.75. Okay. So then let's see what is next. Okay. So on April 30th, you made a payment for all 4 purchases. Write 4 separate checks. Okay? So let's go ahead and go through each and every single one and pay them off one at a time. So starting with the first one, we made a purchase on April 5th. Okay? And we're taking April 30th to make a payment, okay? So in this case, we purchased 1,000 units at $5 each. But, however, that very following couple days later, I end up refunding 200 of those units, which subtracted out $1,000. So in this case, how much is my first payment for my first purchase going to be? How much do I owe? Okay. If I originally purchased the whole thing for $5,100 and I end up returning $1,000, how much do I owe for my very first purchase?
So are you gonna send in a check for 4,100?
Correct, for the first purchase, right?
Right.
Now, let's take a look because they also gave me some terms. They gave me a 5% discount if I paid it within 10 days. If not, the bill is due in 30 days. So did I make the discount due date, yes or no?
No.
No, if I waited till all the way to April 30th to make a payment, which is only 25 days, so in this case, no, I do not get to receive the discount. So in this case, that is correct. We're going to be writing a check for $4,100. Okay? Now, how would I journalize that?
You'll be checking.
Checking first or checking last?
Checking first.
Am I increasing my cash flow? Am I decreasing my cash flow?
Okay, you're decreasing your cash flow.
Yes, so therefore, checking is going to be at the bottom. Okay, because you're decreasing your checking. Now, what else are you also decreasing?
Your accounts payable.
You're going to be reducing your accounts payable. Okay, good. So again, you said for $4,100. Okay, so again, then you're going to go ahead and say payment on purchases made on April 5th. Okay, check number 1. Okay. So let's look at the second batch of inventory that we purchased, right? We purchased on April 10. Okay? So we purchased 750 units at $5.75 each. However, right, 5 days later, we end up returning 50 of them because they were broken due to shipping. So in this case, I originally charged my on an account on April 10, $4,387.50. However, because of that refund, I end up refunding $287.50. So how much do I actually owe for the second batch of inventory?
And what was the amount for the broken mugs?
$287.50.
Can you be making a check for 4,100?
Okay. Now, yes, that's what you owe, right? Now,
Mm-hmm.
in this case, I was also given another opportunity for a 5% discount if I pay within 10 days. If not, I have to pay in 30. Now, if I'm paying as of April 30th, did I make the discount due date?
No.
No, you missed it once again, right? Because in this case, if it's April 10 and you're paying April 30th, that's 20 days. So in this case, you definitely missed it. So in this case, that's exactly what I'm going to do. I am going to journalize the same thing here, right? But this time, and it's for the same amount too. So that's okay. And then again, purchases made on April 10, right? And we used our second check. Okay. So then now we're gonna take a look at our batch number 3. So batch number 3 was April 20th. We purchased 200 units at $6 each on an account. But then on the 22nd, we end up getting an allowance for 25 of those units, right? Receiving a 20% discount. So in this case, let's take a look at what I have here for April 20th. So this April 20th, I charged my account 1220, and I end up getting a refund for $30. So how much do I actually owe this vendor?
Uh, 1,100 and no, was it? Okay. $1,190.
Good. We owe $1,190. Now let's take a look. They also gave us another opportunity for another discount if we paid within 10 days. Okay, so did we make the discount due date?
Yeah, I believe we did.
Yes, we did, right? Because in
Uh-huh.
this case, we're paying on April 30th, which is exactly 10 days after April 20th, right? So in this case,
Right.
we need to calculate what that 5% discount is. Right? Now, in this case, how would I calculate this 5% discount?
It will be on the 1190.
Now, what does 1190 include?
It includes all freight.
It includes the freight. So let's take a look at the original scenario so we know how much the actual freight was. If I purchase 200 units for $6 each, with the freight costing you $20.
Mm-hmm.
So therefore, 20 of those dollars cannot be discounted. So I'm looking at what, $11.70?
Yes.
So what is 5% of $11.70?
$58.50.
$58. $58.50, you said?
Yes.
Okay. All right. Now that you have that, how do I record that discount? Because in this case, right, we know this much, right? We know
Right.
I am paying for what I owe, right? And right
Right.
now I owe $11.90, right?
Right.
Where am I going to take my discount out from?
The 1170,
The $11.70, which is which account?
which would be the accounts payable.
Not accounts payable. What am I discounting right now?
You're discounting your purchase.
You're discounting your purchase, correct. Now, in my inventory,
Every
I place them in all at full price.
Right.
So where would I take my discount out from?
You would take it out of inventory.
You would take it out of inventory. And then last but not least, you're also going to make your payment. So in this case, you're checking, right? So in this
Right.
case, we know for a fact that we calculated it. It was $58.50, right? 5% of $11.70, because we knew $20 was freight. So $11.70, 5% of $11.70 is $58.50. So how much
Right.
is my check going to be out for?
Mm. Would it be for 1190?
No, because you're paying you received the 5% discount. There's no way that you're gonna pay $11.90. Because you remember, terms is a condition. If you make a payment, you're going to get a incentive that you're going to discount your items at 5%. In this case, so I'm making a payment on time, so therefore I shouldn't be paying full price. I should be paying the discounted price. So how much am I actually paying?
So it'll be 1170.
That's what about the discount? So right now I owe $11.90. Okay? I'm going to take a discount for $58.50. So how much should I be paying?
$1131.50.
1131.50, right? You pay less because you receive the discount. Good. So then right here, I'm going to make a note, right? That payment on purchases made on 420, right? Received 5% discount. Okay, and of course, we wrote check number 3, our third check. Okay. So last thing we have to do here is cut our fourth check. So in this case, we purchased on April 25th, 500 units at $6.25 each. This batch of inventory, nothing was wrong with it. So in this case, let's take a look at my purchase on the 25th. So in this case, I owe a grand total of $31.75. Okay? Now, if I'm paying as of April 30th, did I make the discount due date?
Yes.
Yes, you did. So now I need to calculate what that 5% is going to be on. Okay? So in this case, what number am I going to use?
What was the freight?
Freight was $50.
$31.25.
$31.25. So what's 5% of $31.25?
$156.25.
Okay. Okay. So then how am I going to journalize this?
So you're going to do accounts payable.
Accounts payable. What else?
And checking.
What about the discount?
Okay, the inventory discount would be $156.25.
Good. So you have to recognize the discount as well because remember, terms is a condition. You have to pay in order to get that discount. Okay? So in this case, we know we owe $3,175, right? And how much was the discount?
$152.
150. What was the discount again?
Was it 150, 250?
Recalculate it.
Okay. $158.75.
You're doing the discount off of 3,175.
Okay.
Remember, $50 is to freight. You can't discount freight.
And the freight was $50.
Correct. So what is 5% of 3,125?
Was it 125 or 175?
Well, three 3,175 includes freight. Can you discount freight?
No.
No. So you're down. Freight was $50. So in this case,
Okay.
you're down at 3,125. So what's 5% of 3,125?
$156.25.
Good. So that means how much are you actually going to pay this vendor?
$3,018.75.
Let's do that calculation again. How can you pay someone 18,000? Wait, sorry. 156.25 minus 3,175. Okay. 3,018.
75.
75. Yeah, okay, that was correct. Sorry. All right, now let's change our description. So we paid purchases made on April 25th. Okay, received 5% discount. This time, this is check number 4. Okay. Awesome. So, like I mentioned, right? How do you like perpetual inventory? Much easier, right? You don't have to deal with any other account except for inventory. How do you like it?
That's good.
Okay.
Matter of fact, that's the type of accounting I'm used to because I